Hi and welcome to On the Record, your playbook for tapping India. Today we will look at if you have to form an Indian subsidiary, then what are the steps and how you should go about it. Please note that this is applicable only for global businesses headquartered outside India and the founders are not based in India. If you are a founder who is based in India with an international HQ, then you should refer to our other videos where we have covered the ways how you can create your subsidiary or enter India in different options. So if you are a global business who is trying to set up a subsidiary in India, how would you go about it? Before you start thinking about what is the right type of subsidiary, you should first identify or answer the question what are the activities that you will do in India. Is it just gonna be tapping the talent of India, incredible talent, or will you have a business operations? Are you here to tap the Indian markets? That means you have potential customers in India with whom you do business. Are you here for any manufacturing activities or make in India kind of thing, or you are here to make in India for the world, or you are here just for sourcing materials, natural resources, or any other spare parts or anything else. So these are few activities that you should first list down what is the purpose of entering India. Based on this, there could be multiple options that you could look at. The most popular option is setting up a subsidiary by a private limited company. You can also look at options like LLP. You can do liaison office, you can do a branch office, or you can even do a project office. These are not very popular modes of doing business, especially liaison office. It's only there if you just want to have a team in India which is gonna be liaising on your behalf. It could be with your vendors, it could be with your customer, but it cannot have any commercial activity in India. No income can be generated, nothing. It is just a facilitator for you to do business better. The second is a branch office. Branch office is not considered to be a true legal entity. It is an extension of your parent entity, whichever company you have, but you are permitted to have commercial activities in India, and whatever taxes are applicable, you have to continue to do that before you can repatriate the money out of India. The third is a project office. Project office is for a very specific purpose, for a specific project that you are doing. So you have to share all the details of the project, the duration and stuff, get approvals, and then you can have a project office which is allowed to have commercial operations and repatriation is allowed. But these three are not very popular and they are very complex. They require special approval and it could take a huge time to set them up, along with the history of the parent company, because you need at least 3 to 5 years of profitable history kind of thing before you can start setting up these operations. So let's look at the most popular way of doing business in India, which is setting up a subsidiary via a private limited company. Now, to establish a private limited company, you need at least 2 shareholders in India. Now, both the shareholders, depending on the sector in which you are operating, there is something called sectoral cap. So, for example, if you are into IT or some services, you are allowed to have 100% FDI into those companies. That means both the shareholders can be sitting outside India. Generally, when you are talking about subsidiary and a wholly owned subsidiary, you typically look at 100% ownership. But since you have to have 2 shareholders, you can choose to give one nominal share to any other person apart from the parent company. The person could be another co-founder of the parent company, or it could be one of your potential employees in India, or anybody else. It could be any of your relative or anybody else that you want to. Mind it, it is just a nominal share. If you want, it could be 100% owned outside of India as well. Then the second condition is you need 2 directors also. Now, directors are not shareholders mandatorily. It can be like you can have the same person being the director and a shareholder. But one of the important condition is 1 director. So you are allowed to have multiple directors. Minimum is 2. One of the directors should be resident of India. I'm not saying he should be an Indian citizen, but he should be a person who is residing in India. So that is the second condition that you should look at it. Now, to incorporate the company, there is a series of steps that needs to be followed. It is best to talk to an expert or hire and engage an expert chartered accountant or a lawyer or a company secretary who can help you to set up the entire company, because there is a lot of company laws that you should be looking at, the objectives of the company, what all activities you will be doing. So engage with someone, incorporate your company. After incorporating, you should also take a bunch of licenses, things like GST, PAN, TAN, professional tax, shop and establishment. There could be be labor licenses applicable, there could be specific licenses that is needed for whatever activities you are trying to do. Again, an expert guidance is highly recommended based on what activities you are planning to do, what domain you are in, what sector you are doing. So you have to obtain all those licenses in sequence or in parallel depending on again the licenses that you are looking for. The third thing is you should also be opening a bank account. Once the bank account is operational, you have to first transfer the subscription money of all the incorporation shares to the bank account. After that, there is something called commencement of business. So once the subscription money is received in the bank account of the company, all the subscription money, then you go ahead and file for commencement of business. Once that approval comes, then you are technically allowed to do any business transaction within the company. There is a limit within which you have to obtain the commencement of business, which typically range around 4 to 6 months. Within that time frame, you mandatorily have to open the bank account, bring the subscription money, obtain the commencement of business certificate, and then only you can start transacting. Before that, if you do any transactions or enter into any kind of agreements, that could lead to penalties and violations of the law. Typically, it takes anywhere between 6 to 18 months to be completely operational, right from identifying where to locate, what kind of structure, what are the activities, what are the other compliances, incorporating the business, obtaining commencement of business. It could be shortened depending on the timelines or how readily you are with all the supporting documents for the parent entity and how swiftly your team acts. But in most practical scenarios, we have seen anywhere between 5-6 months to be completely operational to anywhere between 12 to 18 months as well. So once the company is incorporated, now comes the operations of the company. So whatever business licenses you have taken based on your activities, you should try to arrive at a compliance calendar. And we have covered this topic in much more detail into another video where we are giving you a walkthrough about what are the various compliances that you should be knowing. In the interest of time, we are not covering that in detail here. So please stay tuned to watch that video around compliance walkthrough for an Indian subsidiary. So once you have the clarity about what are the various compliances applicable, again you would also need an expert partner to help you with all these compliances, things like payroll, filing of all these returns, completing these compliances and stuff. So it's best to arrive at a compliance calendar because in India, every business license have its own requirements. Few are done on a monthly basis, few are done on a quarterly, and then there are annual set of activities. So you should arrive at a compliance calendar so that you are on top of it. You should also look at ways of devising systems and processes to monitor if all the compliances are being done on time or not. Gone are those days when India used to be everything offline. Now majority of things have moved online. So there is nothing called a backdated filing that you can do. So delays in compliances or non-compliances can result into hefty penalties, interest and stuff, and a lot of things are not even fixable. So it is always good not to drive these things yourself, but try to engage with an expert who can help you with all these compliances. In India, the compliances keeps changing every now and then. So it is also important for you to be updated with the latest changes so that you know what it is and how is it impacting you, as well as how you can continue to be compliant. Now there are two important things that I wanted to highlight. One is transfer pricing and one is dividend distribution. So depending on your kind of activities, transfer pricing is applicable between a parent and subsidiary. Any transactions that happens between a parent and subsidiary is eligible for transfer pricing. In a very simple term, a transfer pricing is a markup on the cost of operations of India. That money should come to India, you should end up paying a tax. So technically, if you are a tech company or a cost center who is just offering services to the parent entity, you cannot be in loss. Every month on month, right from day one to day end, you have to be in profit, and on that markup, you will end up paying a corporate tax. And after paying the tax, whatever extra balance remains, you can only use it for capex purposes, not for opex purpose. So you should be aware about what transfer pricing is and how it impacts, what is that markup that you should be charging from India to the parent entity, and bring that money to India as a regular invoicing and billing. This also brings some cash load on the early stage startups because a lot of cash gets blocked and every month you keep accumulating some cash in India, but there is no choice. There are ways where it could be optimized a little bit by giving some deferral credits and stuff for some time, which is typically around 6 to 9 months, but then It cannot go beyond that. Now what happens? What will you do with this extra cash that is sitting in India? One way is you can repatriate this money back to the parent entity by distributing a dividend, since they are the majority and all the shareholders. So you can give that back to the parent entity by distributing a dividend. Now dividend distribution has its own compliances associated. So again, talk to an expert to complete that. You have to pay some dividend distribution tax, and then you can repatriate that money back to the parent entity. If you are a startup who continuously keep raising money at the parent level, your books of account, your all contracts, your compliances, everything would also be up for due diligence whenever you are going through a due diligence at a parent level. So it is important to work with a team which understands all this, and then make sure that you are compliant, and whenever you are raising your next fundraise, your due diligence is done faster so that you have the money into your bank account ASAP. The next point that you should also be aware of while setting up a subsidiary in India is what are the ways you can exit out of India. So one, certainly you can do it through merger and acquisition, but please remember they are little more complex and it requires special approval from company law tribunals, and it's a really complex process. So many times, like in the past, we have seen people advising, like if there is a merger happening, you do a clean merger. Like if it is a tech company which is just having laptops and employees as the assets, so the employee resigns and then move to the new merged entity, the laptops are transferred, and then you go for dissolution of the original entity. If it is liquidation or wind up or post merger, if you are following something similar and then trying to dissolve, then you should be aware that it takes anywhere between 3 to 4.5 years to close the company, and this time starts only after cleaning your books of account and having closed all the business transactions. So you have to fix a date. After that, you have to have a 2-year waiting period before you can file for closure, and then once you file for closure, it takes anywhere between 1 to 2 years for the closure approval to come. And during this waiting period, you cannot be doing any business activities. If you do, then the meter resets to the new date, after which again you have to wait for 2 years. So these are some options that is available for India. Choose wisely depending on the activities, what is the best way to go forward. Private limited certainly is one of the most popular and acceptable way of doing business in India. Even the employees, vendors, the customers, everybody is comfortable with the branding, the structure of this. So it is important. So choose wisely and then take the next steps. Thank you so much and take care.